welcome to our special coverage of the most coveted event for global financial market investors. I'm Tanveer Gill and I'm back with the Buffett Trail, ET Now's exclusive coverage of the Berkshire Hathaway Annual General Meeting 2018 in partnership with Motilal Oswal Asset Management Company. And I have the three wise men from Motilal Oswal AMC to discuss what are their expectations from this big event. We are off to Omaha, gentlemen. So I have with me Mr. Ramdev Agarwal, Ashish Somaya, as well as Gautam Sinha Roy. It's that time of the year again. Welcome to the show. This is a curtain raiser to our trip to Omaha. What do you expect, Mr. Agarwal, this time?
A lot is happening. He's sitting on $135 billion of cash. Yeah. So what he wants to finally do, because I think the business value of Berkshire Hathaway is a lot dependent on how he disposes of that 135 billion, and it's still increasing. Like by end of year, it might be 150, 160 billion.
That's true.
So it's now seriously becoming large. So he must be looking to acquire. Last time, both of them, they concurred that I think they are looking at about $150 billion single acquisition. So I think we are going to, at least there will be discussion on that. Second, I think the valuation model worldwide. One of the discussion in last 2-3 years has been that equity markets are cheap, at least in US and US, because of the bond yields are so low. So because say 10-year was at 2% or 2.5%. So effective P multiple was more like 35, 40 P. So if you're buying at 20 P, the growing asset class, bond doesn't grow, but this one grows. It was a kind of reasonable thing.
But that's changing now, no?
That's changing now. So that discussion will become a large discussion that can the yield spike to 4%, 5%, and can that actually derail the entire equity boom?
But you know, 3% also, Mr. Agarwal, and you know, Gautam and Ashish, you may want to come in here, has always been risky for world markets. I mean, the last time we touched 3%, the markets just went into a tizzy.
It's a different world. I mean, you cannot look back and say that at 3% this happened in the past, so this will happen right now. Yeah. It could be very temporary because the oil. I think somewhere oil is playing that nasty kind of thing where oil has moved up very quickly from 60 to 75, and that's feeding in all the commodities. So clearly that's pushing the inflationary expectations. I don't know whether inflation has gone up or not, but inflationary expectation is going up. So if oil goes to 100,
that's the tricky part.
So then what happens to the commodities, what happens to the inflationary expectation, and hence the monetary policy response.
Yeah. What are your expectations? I mean, last year, again, aside of talking acquisitions, it's really going to be about his investment philosophy that everybody would be eyeing, especially at a time when we've come out of a great year, right? 2017 was a great year for world equity markets. What happens in 2018 and beyond? Because this has been the longest bull market to my memory across the world, right? In recent history, even the mother of all bull markets in the 1990s in the US did not stretch beyond 9-10 years. So are we at the tipping point?
So he has spoken about the fact that probably we are in that part of the cycle where you're not getting deals because, you know, there is a spree of cheap debt-filled acquisitions which is happening, and he doesn't want to participate in that. So clearly, if you read between the lines, then he's waiting for that correction in the markets, and that could be because of yield spiking, and that will allow him, that will give him that opportunity to deploy that huge money that he's sitting on. And he quotes Kipling here, that poem, that, you know, if you really can wait it out, and if you do not have debt on your balance sheet, then you would be in the position of power when that correction happens to actually come in and participate and buy assets cheap. And he has done that in the past. He has done that post-Lehman, right? He was probably the only guy who was coming on TV every day and screaming that this is an opportunity, and he was buying assets. So it looks to me like he's waiting for that opportunity by the actions that he has taken, by what he has written, what's happening in the overall M&A market, and by the fact that he is actually quoting Kipling and reminding us that you have to be prepared.
There could be a correction in the works. But here's the tricky part. A lot of global investors are calling for a correction, whether it's in the bond markets, in the equity markets. We've had Dr. Mark Mobius also say that, you know, US markets could fall 30%. So this is very different from how it was in 2007, where there was excess euphoria.
They're all opinions, they're all noise. Let anybody say what is going to happen, but what will happen will happen. You know, so I don't.
Do you think we are at a stage where there could be a steep correction in the market?
Correction, yes. 10% correction, yes. But crash, I don't think so. At least in India, because we are not buying US markets and all. So in India, from 10,500 going to 9,000 even or 9,500 is quite possible. You know, but I don't see that kind of spike, that kind of situation. Even the global, I mean, if there is a rout in US markets, and I think it is going to have impact here also. Maybe we'll have a bigger rout than what happens in US. But if you look at the, say, if the thing is linked to the yield, Europe is still struggling at 1%. German 10-year is still below 1%. Japan is still at 0.1, 0.2. So I think there's a lot of slack, but people are scared. The past, this kind of expansion, 9, 10 years expansion, and we just got the tax cut from 35 to 20%. The earnings are yet to come. People are yet to be soaked into the enhanced earnings in next 3-4 quarters. So I think there are a lot of good news still in the system. There is a earnings explosion in US. The yield part is, I mean, I hope it doesn't go beyond 3, 3.25, 3.5, because there's enough slack in Europe and Japan. So.
But that seems hard, right? And you may want to come in, Ashish, as well. You know, he's spoken about how debt is a bad risk. So yes, equity markets carry some risk, but you should not have debt because that just is bad risk to deal with. But the world is sitting on very high debt. I mean, the US debt levels have gone to $20 trillion, which is double of what the level was in 2006, 2007. And that could be a tipping point, right? Where defaults could come.
Yeah, so, you know, I mean, it's basically part of a cycle, right? So you don't know exactly where the music is going to stop or where the, you know, tipping point is going to be. You look at it the other way around. For example, last year, I mean, in the newsletter, for example, he mentioned that nobody knows what happens when corporate tax rates are cut from 35% to 20%. Okay, we don't know. He said that they had a windfall gain of $29 billion, which I think 90% of that he said that he's committed to investing back into the US itself. And you know, early cycle of rate hikes is always very bad for bond markets and very volatile for currency markets. But as far as earnings or as far as corporate growth or as far as stock markets are concerned, very difficult to forecast how much further you will actually get carried along on the way.
You know, I'm also expecting him to say something about emerging markets, specifically, like give a specific comment.
Why?
Essentially because, you know, the noise is getting louder. I'll take a quote from Goldman Sachs' recent report where they're calling emerging markets rich countries. Emerging markets are looking like rich countries and they are in profile, you know, drawing parallels between developed markets and emerging markets. So at a time like this, you know, one would expect that if all the big investors in the world are looking at emerging markets, Ray Dalio has taken an exposure to emerging markets, EM ETFs particularly, you would expect him to say something specifically about EMs, right? He should bring in investments within this region.
Yeah, but he has not been a great fan of emerging markets. I mean, he has come here.
But things are changing,
He has
sir.
the guys, I mean, his deputy Ajit Jain is from India.
Yeah, true.
He knows enough about India.
Yeah.
Clearly, he's not enamored by, you know, opportunities of investing in India. So, I don't think, and his one basic faith is the laws of capitalism. And that is very well developed only in the developed countries. That's why they are developed countries. You know, here, at a drop of hat, you keep changing the laws. Someday you say capital gains tax is there, someday dividend tax. I mean, every single bureaucrat redefines his tax laws every 3, 4, 5 years. So that's what doesn't suit him at least. He wants something where there is a stability of every aspect of it.
But if you're looking at value, clearly developed markets is very little scope. Europe maybe, but he's bought into 2 Israeli companies. One is Car, which was a full acquisition, and now Teva, minority purchase. Why can't he look at India? Why can't he look at, I mean, China also he made some purchase in the past.
I'm sure they must be looking to invest in India, but where is the sizable opportunity? He's sitting on 135. Look at his size, 135 billion. By the year end, it will be 160, 170 billion dollars. So the minimum deal size you must suggest is not $100 billion. You must suggest him few $1 billion to invest in a high quality company at a reasonable price. Yeah. So he's not going to buy a high quality company at any price.
For example, now Teva is, you know, his bet on generic pharma. And India has got so many opportunities within generic pharma. Even what Biocon is doing, it's turning a page, right, in terms of exploring the biosimilars market. I think there's great opportunity in Indian pharma.
So he can buy, you know, after scolding all the airline companies for such a long period, he can buy all 5 of them. So I won't be surprised if he buys all the companies in India itself.
Yeah.
So he can surprise you anytime.
Oh, you want to come in with your thoughts, Ashish?
Yeah, I think definitely they must be evaluating, given that the opportunity size is increasing. We now have a $100 billion market cap company too, right? And that's an industry where he has entered in the past, didn't make money with IBM, but probably he can consider that. But I'm sure they keep evaluating these kind of deals. But as Ramdevji said, one is the ticket size. And I think, you know, another thing which holds true in investing is nearness bias. So everybody wants, and for the right reasons, wants to remain in their zone of competence. So he believes in America, 90% of his investments are in America, and he believes in staying in that zone because that's where he understands everything, the entire macro, bottom-up stories about companies very well, right? So I guess that is the most important reason why these guys stick to America. It's the same with us, right? Like not comparing, but the most important reason why we invest in India is because we understand India, right?
So he should keep his expertise where his expertise is pretty much embedded. But what about the fact that he's challenging his own old philosophies, right? Buy and hold, classic philosophy. He's lived by it. And now he's kind of saying, okay, maybe that's not the most prudent strategy in this market environment. In fact, I read an opinion editorial about this person who sold our Berkshire Hathaway shares because he says buy and hold in today's market environment is dead.
Yeah. So I don't think fundamentally he's going to change the buy and hold per se, but buy and hold forever, that he's revisiting. Some stocks, I mean, he's saying that the stocks which are not kind of a strategic this thing, he's not owning 100%. If he's owning 100%, it's almost forever. But if he has a minority stakes, clearly it is open to sell, and we are seeing more often that he's willing to sell. And I think he has made some changes in last year that the policy books, you know, the guidelines of holding. There he has made changes that don't consider that if you bought something, we are not willing to sell. So to that extent, yes, he has given in, but I don't think that means a lot of change. I mean, maybe not forever, but 10, 20, 30 years, definitely he will do it.
Ashish, ETFs versus mutual funds? You know,
So
that
I
will
just
always...
want to add something,
Okay, yeah, please.
my 2 bits on the whole buy and hold thing. How I understand it is that when somebody says buy and hold, because you know, a lot of your viewers are our investors, so I would like just for them to clarify that every investment we make is a hypothesis, right? And companies declare their sales numbers every month and the results every quarter, and you know, so every hypothesis you make with actual market data is getting retested pretty frequently. So buy and hold actually doesn't mean that you're buying and forgetting. There's a lot of work which goes into buy and hold, and you're reevaluating your decision. I can stretch it to other extent and say that we are reevaluating our decision every month and every quarter. But if it is moving along the path which we originally hypothesized, then what is the reason to sell actually? So buy and hold is also contextual, and there is a lot more detail which goes into actually the buy and hold thought process. And yeah, I mean, on your point on ETFs, and I mean, my takeaway last year, because there was a lot of debate because he mentioned that, you know, you should look at passive. I still feel that what he was saying, he said that if it was my wife, you know, I would tell her to put into passives. I think what he's trying to say is that very difficult to find a great manager. One is it's not everybody's cup of tea to become an investor themselves. And second is that great managers are few and far between. So if you're not a Warren Buffett, and he said that Warren Buffett is blessed because he has Charlie Munger, who kind of influenced him. So if you can't find a partner like Charlie Munger, and if you can't be Warren Buffett, then you're better off putting it in the index
fund.
So what he's saying is that, you know, look, if you have a process and a philosophy and discipline and patience, then you're fine. But if you can't find such a manager, then you go to ETF, which I don't think anybody disputes. I mean, we all agree that you need a great manager to manage.
No, but
your
he's
money.
talking about that 10-year bet where he won. He's like 10 years
That
and
is
index
against the
funds
hedge
will...
fund. Index fund winning against the hedge fund, because hedge people,
They buy
take
and
a lot
sell
of
a lot.
fees. No, one is that. Second is they take a lot of fee.
Yeah.
So the on downside they
Cruise to
don't
20.
they don't punish themselves, but on upside they take 220.
Yeah.
So you know, so it has not worked well. So he put that bet. It was more of a kind of conviction than anything.
But I urged him last year, sir,
Yeah.
to invest in an Indian mutual fund, and he said, no ways, I'm not doing that in the US, I'm not doing that in India.
Why did he say that? Why he's sitting on why doesn't he buy ETF himself till he buys a?
Yeah,
In
that's
fact, you should ask, if you by chance meet him, you ask him.
But you know, the bet that he
note it
placed,
Yeah. You must
the
ask
bet
him.
that he placed, I studied that whole thing, you know, when the 10 years got over and everything, I studied all of that about it. It had huge number of hedge funds which are fund of funds. So just think of it, you're buying a battery of funds.
Yeah.
Those funds are funds of funds.
Yeah.
And the underlying funds are again owning stocks and futures and hedges and all those kinds of things. So I'm sorry, but I don't know how was it actually supposed to outperform, because even in India, if you buy some 20 different mutual funds which is owning 50 different stocks, I mean, it's cliched, but you never beat the market by buying the market.
No, so just the example that you gave about 2017, where index funds, are at an index level, at the headline index level, did outperform individual funds. Okay, make that point and I'll continue.
Yeah, sorry. So there's a lot of debate in India also, wherein people are talking about funds not beating the index. But again, all these things are very contextual in nature. 2017 was outlier. I don't think it's ever going to come back. At least whatever 20 years I remember, year by year, it's the first year in history that the Sensex was up 29%, Mid Cap 100 was up 48.5%, and BSE Small Cap was up 57%. Just the calendar year. Now you stretch this by 15 days on either side. So you take the bottom of Demon and you take the peak of Jan 2018, and all these big numbers I said, they blow out even further. So how do you expect someone to beat a 100 stock index where the whole index goes up 49%?
No, that indeed.
Just a 1 year data.
And also, my only thought process when he was giving me his rationale for not believing in mutual funds or hedge funds or active fund management essentially was the fact that the US is a mature market. India and other emerging markets, there's still a lot of inefficiency in the system which active fund managers can take advantage of, arbitrage gaps which you can take advantage of and show that outperformance, because we are still in the stage of maturing, we're still in that process.
The other aspect there, Tanveer, is essentially of fund manager selection. Like Ashish was mentioning, if you take, let's say, a pick of 10 fund managers chosen by someone like a fund of fund, but even that amalgamation of those fund managers to beat the index is tough. So that essentially, that data point tells you that to choose 10 fund managers just based on their past performance and in such a way that they continue to beat the index over a long period of time, that is a tough job to do. And that's so true. If you look at fund managers' track records, even in India, it keeps changing, right? So there are fund managers who have done well in a certain period of time, then they don't do well over another period of time. So selection of fund managers in a way that it will ensure good returns going forward is another aspect that he's referring to there. And hence, what Ashish said is so true, that active management is fine, but to find the right active managers who can also manage scale, that is a different challenge altogether.
But do you think, Mr. Agarwal, that going forward for any AMC in India, there would be rather some diversification into passive investments as well as part of the product portfolio?
No, every AMC doesn't have to offer passive products, but they have to be aware of the competition from passive products. So I cannot be a very big name and keep underperforming for 1 year, 2 year, 3 year, 4 year. I think somewhere the investors will say that hell with this terrific brand equity, let me buy an ETF for 10 basis point and don't have the manager risk at all. Why should I take a manager risk? My beta I'll get in any case 14-15%, what India performs I'll get. Why should I bother about whether this joker is doing well or not? So that, 4-5 years back, 6 years back, when the concept of ETF was not known or not popular, then you could get away with anything. Yeah. But now I think with the larger allocations, every individual has become so much bigger, 100-200 crores single investment, single individual investor. There are so many of them. So they are very wise and they have people to advise them, and then they'll go for ETF way. Yeah. And so I think the real competition for the AMCs, active managers particularly, is going to be the ETF, not the peer set.
Yeah. But when do you see that competition threatening AMCs? At what point on a timeline do you expect that to be a clear and present competition and danger for AMCs?
See, in the world of internet and so much of information, it just doesn't take much time. I mean, it all depends on what level of underperformance the active managers have. If 70-75% keep performing, then ETF will find it very difficult to become popular. But if for 1 or 2 years the active managers only 40% perform, all the newspapers and your channel, they will throw mud on their faces. Yeah. And then, of course, the ETF has a great chance to come back.
Right. He's going to talk about valuations. Do you expect that? The market valuations at this point in time, and how he believes that, companies, in order to justify those valuations, are looking at expansion through the inorganic route. I'll tell you one of his quotes in the annual shareholder letter: if the historical performance of the target falls short of validating its acquisition, large synergies will be forecast. This is essentially talking about the approach that leadership and CEOs take to managing companies. Spreadsheets never disappoint.
He has talked about that. And valuations and interest rates are obviously linked at the hip. So because interest rates have been so low for such a long time, valuations have gone up. And he has specifically mentioned that in 2017, the one reason that they didn't do many deals was the fact that valuations were always very stretched. And on the counterparties, the other people who were actually looking at those deals were essentially debt-filled companies, who were looking to do leveraged buyouts. And because debt was cheap, it was very easy to justify such valuations on a spreadsheet because, it becomes EPS accretive from day one or whatever. So, he has obviously said that valuations have been expensive for him. And if you're saying that something is expensive, then indirectly you are saying that you're waiting for it to correct, right? And he believes that will come down. Probably that will be driven by interest rates going up. And since the letter was drafted, interest rates, even before that actually, interest rates have actually gone up in the US. So let's see how the 2018 pans out for them.
Yeah, do you think, because in my interview, he did not expect interest rates to go up as much as they have gone right now.
He's a very bad in macros. Huh? His track record is horrible.
I shouldn't have asked him that.
Even in 2008, I remember, he was very clearly asked at the peak of bull run in 2007-8. And he said nothing doing it. There are a lot of new jobs getting created. All the houses, whatever slack is there, will be taken care of. And we had one of the worst decline in US history. So don't count too much on his macro. He himself doesn't like his own macro calls. So why you give so much of credence to that?
Well, what do you expect him to say about the valuation scenario currently?
He's going to say again, if he has said already, he said, if by chance you think that US 10 years is going to spike up to 350, we are reasonably priced. But if you think it is going to go to 450 or 500, all bets off.
All bets off.
Yeah. So, and this macro thing, global macro is such a crazy thing. How, you tell me what is going to be the oil price in 6 months' time? Will it be 60 or will it be 100?
Very difficult.
Very difficult. So
most volatile market.
Yeah, most volatile market. Aluminium going to 2,500 and coming back to 22.
These commodities.
Yeah. So what are the drivers of inflation? What are the drivers of your US risk-free? In 1982 it was 16-17%, the same 10-year, which crashed to 0 or 1% in 2009, 2010, 11. And today now it is climbing up to 3. Will it stop at 3.5 or will it go back to 16?
Yeah, it's going to be tricky, very tricky.
So that remains one of the major discussion. I think all sorts of questions will be asked and all sorts of discussion will happen.
Yeah, but the three of you are going again, and this year I believe the contingent is of 85 people. Last year it was about 70 people.
Now we don't have rooms there. No, we don't have
I know,
rooms.
you book out a complete hotel. Clearly there's a lot of excitement in seeing the event live, right? Because that's a completely different experience for our viewers tuning in right now. Share a bit about that.
Yeah, so I think good thing is now for last 2 years they have been streaming. So obviously everybody cannot
But
go.
Streaming live, sir, versus seeing the event in person.
You can tell the difference, but having seen once or twice, I think the people don't have to. But seeing it live is a lot of fun. But you got to have full supply of coffee. Sit with
6
that
hours.
in the night, particularly night here. So you'll feel sleepy. But I think it'll be fantastic, and you can kind of mute and stop and then hold it and play it a little later. But I think that day itself, people must, instead of watching IPL, you must watch that day on a 5th May evening in India. I think 5-6 hours, it's worth listening to him. It'll be fantastic discussion.
So, for us, it's kind of an important event because we are in some way influenced. Our investing style, what Mr. Agarwal has evolved over the last 20 years, like he says himself, to an extent is influenced by what Mr. Manjar and Mr. Buffett has been talking about. So we would like our business partners to kind of hear it and get a sense. But if you say in terms of takeaways, what I always share with our business partners, and last year at the end of the conference, I kind of pointed out to them, we were there from 8 in the morning till 3:30 in the afternoon. Okay, not one question about market kya lagta hai. Okay, all the discussions are actually about companies. What is their earnings trajectory? What do you think is going to drive returns going forward? Last year Mr. Manjar gave such a fantastic explanation when he was asked that what kind of return you think Berkshire can make in future. And he gave a whole construct of where inflation levels are, where interest rates are, what are real rates, what should the risk premium be, and how equity will play out. So humongous learning, provided you take it in the context. I don't think we'll end up there and expect him to tell us how the market will behave. But definitely we expect him to teach us.
And
few
even
things.
if it tells, it is of no meaning.
It's of no meaning. Gautam?
So for me, you know, I am a student of investing. So for me, it's like attending a live course by the best professors ever.
Live is better than TV, tell our
Live
viewers.
is way better than TV, trust me. Because you don't get the feel on TV, right? And you're taking notes, and those 6 hours just fly by for me. I don't even need to do anything else but listen to them. And you know, like Ashish was saying, they cover everything about investing. And the one key lesson that keeps coming back to you, and they have mentioned in the letter again, is that stocks are actually the most volatile instruments in the short term. So if your horizon is 1 year, even 2 years, stocks are very volatile, the results could be anything. But the beauty is, as you extend that horizon, your duration of investing, take it up to 10 years more, stocks are the least risky investments, least volatile investments. And that is the key message that everyone needs to be reminded about after you hear them.
Yeah, oh, absolutely. What was really fascinating for me was that you have this convention center filled with 40,000, 50,000 people, and they're not there gathered to see a band perform or see a sports match. They're there to see these two gentlemen who are in their 80s, 90s, you know, speak about their investment philosophy. That just takes the cake.
So you're meeting him again this year?
That is a secret. But yeah, let's hope.
We'll recommend your name.
Yes, thank you so much. But we'll have a great time there, and of course we'll get our viewers a sneak peek into what your own analysis is from the entire event. Thank you very much, all three of you, for joining us in this special Curtain Raiser episode. See you in Omaha then. Thanks very much for watching.